I've been with Eureka now since January 2008. If anybody remembers, January 2008, it was just a couple of months after the first crumblings of the crash that was coming at that time. And I very much love working with Eureka Report. You're a wonderful audience to write and very, very responsive, which has been great. But I also need to point out that January 2008 is about 9.5 years ago, and I'm starting to talk to Ron about long service leave. Today I'll be talking about the three things as mentioned: the new super contribution rules, how to maximise your concessional and non-concessional contributions in the lead up to June 30, and the new incoming pension cap rules. So the government had said enough is enough, and 25 years after compulsory superannuation was introduced, the wall of money simply got too big for some Australians. So as I said on budget night last year, these are the biggest changes in 10 years and the worst changes in 30 years. It is now tougher to get money into superannuation, or it will be as of July 1, tougher to get money into superannuation than it has been in a long time, in a very long time. Remember, it was only 10 years ago that you could get $105,000 a year per job that you held into superannuation. We then went to 100,000 total, which got dropped to 50, eventually to 25 for 1 year, before it moved up to 30,000 and then 35,000 for the over 50s. From July 1, obviously, the first big major change, which is where most of money that goes into superannuation comes in, is we're dropping from 35,000 and 30,000 down to a flat limit of 25,000 for everyone. Concessional contributions. Concessional contributions are those that can be claimed as a tax deduction, either by the employer or by the member. So it covers superannuation guarantee payments, salary sacrifice contributions, and personal deductible contributions made largely by the self-employed. Non-concessional contributions are the after-tax contributions, the ones that you make from your personal savings outside of that aren't receiving a tax deduction. This limit is falling from the $180,000 a year that we have now down to $100,000 a year. Until June 30, you have one final chance in order to get up to $540,000 per person if you're able to get use the pull forward rules, and there are conditions to that, which means that for a couple, potentially up to $1.08 million can be got into your super funds prior to June 30. From July 1, of course, it falls to $100,000 a year, and the pull forward will be reduced to $300,000 if you're able to contribute. Now, everybody's heard of the $1.6 million limit, but is everybody aware there are two $1.6 million limits? The first one is regards to the transfer balance cap, which is how much money you can put into a pension account in your name. The second $1.6 million limit is actually in regards to non-concessional contributions. If you have more than $1.6 million in your combined super accounts, whether they be super, pension, defined benefits, you can no longer put any non-concessional money into super. Between 1.4 million and 1.6 million, you are able to put some non-concessional money in, but you are restricted on how much you can do. For example, between 1.5 and 1.6 million, you can put in a single $100,000 contribution. You can't use the pull forward provisions. Between 1.4 and 1.5 million dollars, you can put in 2 years worth, or 100,000 plus 100,000 of pull forward. You can only put in the full 3-year pull forward contributions if you have less than 1.4 million in super. This is the big one that's going to make it almost impossible to create the very large super funds, or self-managed super funds particularly, that we've had in the past. And by the way, if anybody wants to educate their children on how to make the biggest possible super fund that you can with the new rules going forward, it's going to start with making $100,000 contributions from age 18. You'll run out of being able to do that by roughly about age 27. or 28, depending on returns, and putting in $25,000 worth of concessional contributions each year. Now, that's probably only going to be possible for a limited number of Australians, and your surname will probably need to be Lowy, Packer, Murdoch, Reinhardt, Pratt, Triguboff or Fox. One of the improvements to the contribution rules, however, and speaking of which, the Pratts, so it's back to Melbourne. Anthony Pratt is going to be named Australia's richest person tomorrow. One of the improvements to the contribution rules is the 5-year catch-up provisions. This doesn't kick in until July 1 and will only be prospective from there. Therefore, if you have a year post the FY19 year, FY20 or 21 or 22, etc., and you haven't used up your full $25,000 concessional contributions, you'll be able to use those years going forward in order to be able to catch up. For example, if you don't put in anything for FY18, 19, 20 and 21, in FY22 you would be able to put in up to $125,000 worth of concessional contributions. But there is a condition on that, and you must have less than $500,000 in your super funds. Once you have $500,000 or $500,000 in super, you will no longer be able to use the catch-up provisions. The other big change, or one of the other big changes, is the ditching of the 10% rule, which I'll come back to shortly. How to maximise your concessional contributions and non-concessional contributions this year. There are only five-ish weeks left of the current financial year, and in order to make the most of them, this is the time period that you have to do it. When it comes to doing it, I'll take the words from John Cougar Mellencamp classic, come on baby, make it hurt so good. And that's around, you only have a short period of time to do it, and the pain that you can possibly accept now and prior to June 30 will have benefits. If you are over 50 and able to make that extra contribution up to the $35,000 limits this year, where you might not necessarily normally do so, the ability, there's tax savings of up to $3,400 for doing so, but more importantly, being able to get that extra money into super and allow for the investment compounding. For the under 50s, the advantage is a little bit less, obviously. It's only falling from $30,000 a year to $25,000 a year, and they're often usually at a different stage of life where they might have monster mortgages and midgets taking up some of their time, but it's certainly worthwhile if you can make the most of the concessional contribution limits before they fall to $25,000. How do you get the money into super? Well, make sure it's a little bit difficult if you've got salary sacrifice. You can only salary sacrifice income that you haven't earned yet. If you need to make those arrangements for the remaining 5 weeks of the financial year, then you'll need to be in contact very, very quickly with your employer to make sure that you can salary sacrifice something of the remainder of this month and June. For the self-employed, it's a little easier. Generally, you're just able to transfer the money from one account to the next. But I do want to make the point that you need to ensure that your super fund receives the money by June 30 at the latest. If you're doing an overnight transfer from one bank account to another on the 30th of June, it won't arrive until the 1st of July or possibly the 3rd of July, if that's, I think June 30 is a Friday this year. If it arrives on the 1st of July or the 3rd of July, it counts towards next year's contributions, not this year's, no matter what time you made it. Also be aware that with BPay, a lot of BPay takes 2 days to arrive, so you want to be making those contributions somewhere prior to the 28th. One of the wonderful things that is changing along with the 5-year catch-up provisions is the removal of the utterly ridiculous 10% work rule that has applied for a very long time. This is an advantage because it means that people no longer will only be able to make their contributions via their employer. The 10% rule was that if you earned more than 10% of your income as an employee, then that was the only way you could make contributions to your super fund. For example, if you have somebody who's working part-time as a consultant earning $80,000 a year, and working part-time as a teacher earning $50,000 a year, the only way that they could make contributions, concessional contributions to super was via the employment that they had as a teacher. This rule is going, and anybody will be able to make concessional contributions going forward. You can do it on a monthly basis if you want, or a weekly basis, or you can do it all in May and June as you get closer to the June 30 deadline. But that's it's a very significant improvement, particularly for those people who are part employed and part self-employed. It is getting close to being, depending on the asset, it's getting very difficult and almost too late in the piece to be able to be making significant non-concessional contributions, but you do still have the opportunity to do so if you can prior to June 30. Selling a property now and getting that money into super might not necessarily be possible, but certainly if you have shares that you're either able to in specie transfer into your super fund or sell and get the cash and move into your super fund quite quickly, these are things that you can do in order to make the most of this final opportunity to get in $540,000 into your super fund. It may, in some cases, and if you want more information on this, I wrote a column on this back in January, it may, for some people, make sense to borrow money prior to June 30 in order to get that their $540,000 in non-concessionals into super. Why is it worthwhile? Look, the last big opportunity we had for this was in the lead up to June 30, 2007 with the $1 million that you could get into super. But at that time, interest rates were 7.5 or 8%. Obviously markets had been running very strongly for about 4 years at that point. It's a very different situation now. Interest rates on your home might even have a 3 in front of them, but certainly shouldn't have any more than a 4 if you were to borrow the money. And there is that possibility, particularly if it's a short-term requirement, because you have money coming in later in the year, possibly from the sale of a property or something. But anyway, if you want more information on that, please see a column I wrote in January. On to the incoming pension cap rules. Of all the new rules that are coming in on July 1, this is the one that causes the most confusion and the one that is going to cause the most money, cost the most money in tax for the most people in this audience. From July 1, we get a $1.6 million limit to the initial starting value of a pension fund. That's for an individual, so a couple could have up to $3.2 million. Plenty of people in this room will know that there is pain to come right here and will have been wondering what can be done to minimise that pain. In certain circumstances, there will be things that you can do at the margins to do so. But essentially, $1.6 million in a pension fund is it. Importantly, it starts, the counting of this $1.6 million starts with a defined benefit pension if you have one. If you have a defined benefit pension, that is the one that's counted first because it's the one that nothing can be done about. And for example, if you have a defined benefit pension of $50,000 a year, that will be multiplied by 16, which in this example equals $800,000, and that is half of your $1.6 million limits. But it's important to know if you have a $100,000 defined benefit pension, then that is your entire $1.6 million, and you won't be able to have any remaining ability to use your a pension fund within your self-managed fund or any other fund that you might have. After the defined benefit pension comes what you have in your super fund, and up to $1.6 million. If you have a larger super fund, then some of that money will need to be changed back. If you do have in excess of $1.6 million, you essentially have two choices. The first choice is to revert some of that money back to superannuation, to accumulation, where it will be taxed at superannuation or accumulation rates, being a maximum of 15% or 10% for capital gains. The other option you have is to pull the money outside of the superannuation system altogether. Now, that is obviously going to mean that any money those funds earn are going to be taxed at marginal tax rates. What I've talked about during a few pieces in December and earlier this year is what is known as the three buckets that people will need to know about and be considering. The first and best bucket is the $1.6 million that you can have tax-free in your super fund, in a pension fund. The second bucket actually is what you can have outside of superannuation that keeps you under the tax-free threshold. So if you were to have $500,000 to $1 million, depending on what the assets are earning outside of super as your only assets, $500,000 earning 4% is $20,000 a year. That $20,000, if that's your only earnings, will keep you roughly under the tax-free cap, or tax-free marginal tax rate of $18,200 a year, and you'll pay no tax on that money. The third best option, or the next option, if you've got more than that, would be to have the remainder of your money sitting back in accumulation in your superannuation, where it's going to be taxed at no more than 15%. I do have one client who has a super fund of about $30 or $35 million. Now, he and his wife are going to have to transfer roughly $30 million back into accumulation, and the tax bill for them going forward is going to be around $200,000 a year that they haven't been paying to this point. It is going to be considerable taxation for some people, but the important thing to know is to make the most of the rules as they are and as they apply to your situation, and if you're not sure, please go and see a financial advisor. The last one that I want to quickly talk about is in regards to transition to retirement. Transition to retirement pensions are going to be taxed for the first time come 1st of July. So it is very, very important, if anybody is on a TTR pension, that they do what they can, if they can, to have it changed from a TTR to an account-based pension or an ABP. This can be done this happens automatically upon turning 65, but for people over 60 who change jobs, move employers, and who are on a TTR, it is important to make sure you speak to your accountant, your advisor, or whoever you use to do this for you, to have the TTR changed into an ABP to stop the fund being taxed. A lot of people might miss this when they're changing jobs, but important to do so. The other way potentially of doing so is after hitting your preservation age and permanently retiring from the workforce. Anybody born before 1960, that is of course age 55. Look, that's the last of what I wanted to talk to you about today. Thank you very much, and I look forward to some questions later. Thank you.